SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF Buffy Bocconi e-lecture on key takeaways from the ECB's new Financial Stability Review. Sticky global inflation has required a sharp rise in interest rates worldwide over the past 12 months or so, with uncertainty on how much further and for how much longer the interest rate hiking cycle will need to last in the euro area. The uncertain inflation and interest rate outlook also weighs on the real economic outlook. Refinancing for banks has become substantially more costly. Financing conditions for non-financial firms and for private households have tightened considerably. Real estate prices have ended their upward trend or are falling. European governments are going to feel higher debt servicing costs. Lending has strongly fallen against higher interest rates and real economic uncertainty. Recent unexpected turmoil in the US and Swiss banking sectors indicate fragility. Financial markets are volatile. Now, what does this global and European environment imply for financial stability in the euro area? Where are the possible risks and sources of fragility? How to address them preemptively? The ECB's May 2023 Financial Stability Review, which was released yesterday, analyzes these and related developments in detail. We are privileged to welcome with us today John Fell, Deputy Director General, Macroprudential Policy and Financial Stability at the ECB. John will present key findings from the FSR. Thereafter, two top experts will offer comments and bring in their own assessments of current risks to financial stability. We are happy to welcome Hanna Westman, Chief Economist at the Finnish Financial Stability Authority, and Cristina Cella, Advisor at the Financial Stability Department of the Riksbank in Sweden. Without further ado, over to you, John.
Thanks a lot, Ernest. Let me also thank you and the SUERF board, not only for this invitation, but also for your recurring invitations. When I say we, I'm speaking here on behalf of the whole team. We greatly value these opportunities to share our findings. And of course, we welcome the opportunity for feedback from the discussants and from the colleagues who join these, if I may call them, webcasts. So, we know that our readers, the readers of our FSR, that is, that come from a range of backgrounds, be it policymakers, professionals in the financial industry, or indeed academics. And I think participation in these sessions also reflects that broad interest, keeping it interesting, and I hope useful. So there really is never a dull moment in preparing a review like this, and more often than not, and that's certainly been the case since we've been doing these events, unexpected events can cause us to change the emphasis of our analysis. So, if you remember half a year ago, our main concerns revolved around vulnerabilities that we thought could be unearthed as the economy and the financial system transitioned from a prolonged period of very low interest rates to an environment of tighter financing conditions. Now, while the financial systems of advanced economies had, on the surface, seemingly weathered the swiftest pace of interest rate hikes in recent history, we had concerns that the full impact had yet to be felt. In many ways, it was puzzling that last year's asset price adjustments, and remember, we saw unprecedented double-digit declines across almost all asset classes and all geographies simultaneously last year. But we didn't see the failure of any major financial institution. That was true either outside or within the euro area. Now, still, the evidence suggested that it was having an impact on the euro area financial system. We were seeing greater risk aversion, and we were calling that it was causing a non-bank finance to retreat. We could see more risk aversion. And a key financial stability concern there at that time was that worse than expected inflation outcomes by raising uncertainty about the path of monetary policy normalization around the so-called terminal rate could be a trigger for unraveling some of the known vulnerabilities in the non-bank financial sector, and perhaps even expose some unknown ones too. Undoubtedly, I mean, we had all those losses in asset markets, that the losses must have been somewhere in the financial system. There were unrealized losses yet to be revealed. Now, with the failure of Archegos, that was a family office which was not on the radar of anyone that I know in the financial stability community before the incident happens. It was fresh on our minds, and we thought system-wide stress precipitated by an incident involving one or more non-bank entities skirting the regulatory perimeter was a plausible scenario. Now, what seemed improbable, though, was that the epicenter of financial instability would turn out to be lurking in the banking sectors of not one, but two advanced economies. And we were not alone in holding this view. The Federal Reserve Board periodically carries out surveys with market participants on their views about the main sources of risk to financial stability. And the findings of those surveys can be found in their financial stability reports. So if you take a look at last November, a mere 12% of respondents considered the possibility of stresses emerging within the banking sector as being likely. Now, in the meantime, 3 banks joined the Federal Deposit Insurance Corporations, if I may call it, its hall of infamy. So the failed bank list. And 2 of them claimed the unenviable positions of second and third largest US bank failures ever. Now, responses published in the latest edition, so that was published early last May, show that 56% of participants were harboring concerns that vulnerabilities in the banking sector could serve as a wellspring of financial instability going forward. Now, if I go to the next slide, I think I saw the colleague where someone was not able to see the slides. I don't know if that remains the case or if that was just an idiosyncratic issue. But you can see the slides, Ernest.
We can see them.
You can see the slides. So, I mean, on this slide, and with that preamble, I think it's fair to say that our latest assessment was prepared against a background of challenging macro financial prospects, and that was both. We can say that it was true both domestically and externally. So, on the macro side, 6 months ago, and you can see it on the chart there on the left, the consensus among economic forecasters was for a shallow contraction in euro area economic activity. So you can see that there at around the time of the vertical line then when we published our last financial stability review. Since then, global supply chain bottlenecks faded, of course, after China's reopening, and we had lower energy prices as well, which were a cause for optimism at the turn of the year. And now fast forward to 6 months later, marginally positive economic growth is expected. But those are the central expectations that you can see there on the chart. Around those expectations, the distribution remains tilted to the downside. We have a chart in the FSR which is showing that. And the reasons for that are, I mean, at least twofold, but I mean, there could be others, but it's partly due, of course, to risk aversion following those recent banking sector stresses. And it's also partly because of the ongoing geopolitical risks. And then at the same time, inflation has been proving persistent. So that's a pair of lines, that the upper pair of lines still on the left-hand side chart is both for the euro area and for the US. It's been proving persistent. And as long as expectations remain above our and also the Fed's medium-term objective, that fosters uncertainty about the path of future interest rates. And that dovetails into the financial side. On the right-hand side, here we have some near-term indicators of financial stress, and you can see that they have been trending down overall when you look at the period to the right of the vertical line, so since the publication of the last FSR. And that downward trend is due in part to a very strong recovery of euro area financial markets at the start of the year that I think caught many by surprise. And that was, of course, driven by those improving growth expectations and the energy optimism, and also, of course, the strength of corporate sector profits. Now, you can see that a spike is visible in all of those stress indicators, though, on the right-hand side. It's gone now, but we had a spike up, and that was, of course, largely due to the US and Swiss banking sector stresses, which did spill over to the markets for euro area bank securities. That was, you can see it most strongly in stocks. and also AT1s, especially after the failure of Credit Suisse. But impacts were also felt in government bond markets as market participants thought that the tightening of financial conditions induced by those banking sector stresses might in fact lead the Fed to slow the pace of monetary tightening. So we go to the next slide, and against this background, this is our headline assessment that the financial stability outlook remains fragile. The rest of my presentation then is going to be structured around these three main themes that we're highlighting in the episode this time. So first, valuations are high and market liquidity is low, or lower than it was 6 months ago, and that makes markets vulnerable to negative surprises. We devote a lot of attention in the episode this time to the whole issue of liquidity, both market liquidity and also funding liquidity. Second, the resilience of corporates, sovereigns, and households is being tested by higher interest rates. And I will say something about that later, of course. And then third, well, euro area banks did remain resilient to stress, although we are seeing some liquidity and also some asset quality concerns starting to surface. Now we'll go to the next slide, and the first theme. Notwithstanding the breadth and the magnitude of asset price declines last year, our assessment then was that they could still fall further. And we had that assessment because valuations had not yet reached historical averages. That was especially the case in the US. And then we had this, as I mentioned, we had market staged this impressive rebound at the start of the year. And that, of course, produced renewed valuation stretch. The chart on the left is showing the typical co-movement between equity and credit risk premia for the US and also for the euro area over the last 14 years. The two solid lines, the black lines, are regression lines, so they kind of summarize the average behavior. And you can see there's at least two notable features about what is shown on this chart. So the first is fairly obvious. Risk premia are very low on both sides of the Atlantic. So you can see where the dots, which are depicting the latest observations, where they are in relation to the historical data. And then the second offers a glass half full or a glass half empty interpretation, because now we're looking at relative valuations, and of course, yeah, I mean, you have to be careful, I think, with relative valuation. So either this is showing that equity risk premia are much lower than is typical for the current level of credit spreads, or that credit spreads are too high given prevailing equity risk premium levels. Now we tend towards the former interpretation, and if you just focus on the vertical axis on the chart, it's clear that equity risk premia are very close to the lows over that 14-year period on both sides of the Atlantic. Now, relative to their own histories. Now, given prevailing uncertainties that we mentioned, the downside risks and so on, these valuation stretches, we think, make equities vulnerable to disorderly correction should economic outcomes fall short of expectations. Now, apart from elevated valuations, I mentioned liquidity, so a further concern for market functioning is signs of declining market volatility, and that's especially in bond markets. You can see it there on the right-hand side chart. Now, the indicator that is shown there, well, it's a summary indicator of liquidity in market liquidity in the bond markets. It's explained in detail in the FSR how it's computed, but what it's showing is that the ECB's withdrawal from asset purchase programs has reintroduced two-way risk in both sovereign and corporate bond markets, and that's causing market makers to withdraw. And as they do, market liquidity has fallen, and that has caused volatility to rise in the bond markets. So overall, this has made these markets more prone to adverse dynamics than was the case before, and it may take some getting used to for market participants. It is kind of what should normally be the case. So, I mean, we're normalizing. So going to the next slide and turning to non-banks, although the concerns we had 6 months ago have not by any means gone away, we remain concerned. We continue to have concerns about vulnerabilities in the non-bank financial subsector. It did prove to be resilient during the recent banking sector stresses. So you can see there on the left in green, funds which invest in European and US financials, as well as those exposed to riskier assets, such as high yield corporates. That's the navy blue line there. These funds faced significant investor outflows after early March. So for the former, you can see that the amounts were as much as 4% of total assets under management. So that's a big reallocation. And at the same time, looking above the horizontal axis, you can see inflows into sovereign bond and money market funds picking up. Now, that probably reflected safe haven flows. I mean, it's the usual story that we see when there are episodes of market stress. But I mean, we think it could also be because these funds are now attractive vehicles for parking for parking funds, because they're offering higher rates than deposits are at present, and of course they're low risk. Now, those are the inflows. What about the allocation of these funds by the investment managers? Well, that's shown on the middle chart, and we're seeing some de-risking, but it's not on a sufficient scale for our concerns about credit and liquidity risks to be alleviated. Just zooming in on the middle chart, I mean, you can see there we stratified investment fund bond holdings by credit ratings, and the yellow dots there are depicting the latest data. Now, so you can see there's a reallocation from higher to lower credit risk instruments, and that's probably thanks to the higher returns that low risk instruments are now offering relative to the past. Still, the chart also shows, and if you just add up the sum of the two bars on the left and the two bars on the right on the middle chart, you can see that more than half of investment fund bond portfolios are exposed to either triple B, are sub-investment grade instruments. And that leaves the sector exposed to the risk of credit losses. Those are the riskier credit instruments should corporate sector fundamentals take a turn for the worse. Not shown here are non-banks exposures to property markets, and those have increased markedly in recent years. And here, as I'm going to show in a moment, markets are correcting. Now, with these vulnerabilities on the asset side, concerns remain about the ability of funds to meet margin calls, say, or unexpected redemption requests. If there were a moment of stress and people want their money back quickly, would these investment funds be able to make those payouts quickly from their liquid asset holdings? We think that there is still a risk that some may have difficulty doing that, and of course that means that fire sale risks remain. Those funds might be faced with having to sell assets, and so possibly amplifying any market corrections that we could see. Now, go to the next slide, and moving to the second theme, the impact of higher interest rates on non-financial sectors. First of all, you can see sovereign spreads. Well, first of all, I could say it's not shown on the chart, but if sovereign spreads have been largely contained over the past 6 months, if you just look at 10-year spreads and where they were as we were going to the press with our FSR for higher yielding countries, those have been hovering close to 12-month lows recently. And that's true not only for nominal spreads. So, I mean, taking the difference between the yields on the most risky from the least risky in the euro area, but it's also true of CDS spreads. I mean, there's a genuine easing of sovereign credit risk concerns that is visible in the markets. But we still think the vulnerabilities remain. As I already mentioned, near-term inflation expectations exceeding the medium-term objective. Inflation expectations exceeding the medium objective, that fosters uncertainty about future interest rates, and that manifests itself in interest rate volatility. In turn, that volatility is strongly correlated with sovereign bond spreads, and the sensitivity is also it's higher for lower rated countries. We show that in the review. And at the same time, a large share of outstanding sovereign debt was issued when interest rates were very low. So you can see that there on the left. Most of the bonds that are due to be refinanced, so this is what the comparison that we're making, is that the bonds that have to be refinanced over the next 12 months, relative to what the yields that they had to pay when they from issuance onwards, you can see that they're going to have to offer higher yields. than the bonds that are being redeemed. Now, that's not the case for all bonds. Interestingly enough, you can see some bonds that were issued a decade or more ago actually had higher yields than those prevailing now, but it's only a small segment of the total. So, I mean, we think that we will be seeing a rise in sovereign refinancing costs. Now, at the same time, as the middle chart shows, several countries will have to redeem debt amounts of more than 10 percentage points of GDP over the next year. So, while sovereign vulnerabilities are not front and center in our prioritization of risks, and as I said, spreads are low, vigilance is nevertheless needed here. As for corporates, the rise of interest rates is becoming visible in the deterioration of interest coverage ratio. So here, the measure is the ratio of profits to gross interest payments. Now that's shown there on the right, and we're showing, it's a complicated chart in a way because we're showing a change in a ratio, but we tried to, because we wanted to show a decomposition here. And so corporates typically borrow at relatively short maturities with floating rates, and so transmission here has been relatively quick. It's affected highly leveraged firms. We were seeing it already last year. And the concern here is that these firms tend to have lower profit margins, which could pose challenges for debt servicing. But for now, as you can see in the chart, I mean, we're seeing those rising interest rate costs, but that is being offset by the strength of profitability in those interest coverage ratios. So on net, we are only slightly negative relative to where we could have been if profitability had not been as strong as it has. I hope it's clear from the chart. So we go to the next slide, and moving on to real estate markets. After the pandemic-driven boom, housing markets in most Euro area countries are now showing signs of cooling down. And of course, this is because affordability has worsened, interest rates have gone up, mortgage payments go up in tandem. As the left-hand chart decomposition shows, those dynamics have been stronger in countries that were less affected by previous financial crises. Now, so far, the downturn has been orderly, although nominal prices in a number of countries are now below their peaks. We're still seeing year-on-year house price changes that are positive, at least during the final quarter of last year. But you can see that the year-on-year change is heading towards the horizontal axis. As I said, it's been orderly, but disorderly adjustment cannot be ruled out as higher interest rates are passed through to mortgage borrowing costs. That's a process that is obviously taking place more rapidly in countries where variable rate mortgages prevail. Some indications of this were apparent in the sharp reduction in mortgage demand that was revealed in our latest bank lending survey. And at the same time, the simultaneous tightening of credit standards by banks for mortgage lending suggests now that there's an uneasiness, let's say, among banks to increase their housing market exposure. So there is some risk aversion there now, evident in our bank lending survey about those exposures. Now are increasing them, at least. As for commercial real estate, the downturn here is more firmly entrenched, as you can see there on the right. First quarter data is showing the valuations and transactions are both contracting, and they're contracting at double-digit rates. Now, while that suggests that the commercial property demand curve has shifted to the left, I think caution is warranted here. Maybe in interpreting, we're showing here the valuations of appraisers and transactions, and it's a bit like, let's say, the denial stage of the 5 stages of grief. It can take time for valuations to reflect the true market reality, and unwillingness to sell at low prices can be an explanation for low transactions and why we have low liquidity in the market at the moment. Ultimately, the dynamics are going to depend on, of course, the fundamentals. So those are the cash flows that are generated by those properties, the rents, and they are in turn vulnerable to adverse economic growth, or indeed interest rate surprises. I mean, the tenants themselves may be faced with interest rate risk. We'll go to the next slide, and turning to the third and final theme, the resilience of Euro area banks. Well, first of all, a positive sentiment towards the sector at the turn of the year is visible on the chart there on the left. But that was reversed by the failure of 3 US regional banks, and then also the takeover of a Swiss GSIB. Now, you can see that they held on to their new year outperformances vis-a-vis US bank stocks. And here we've got two sets of relative performances here in a way, because I've got this is the performance of bank stocks in both jurisdictions relative to the broader market index. And also you have got a comparison then between the US and the Euro area. And you can see that Euro area banks, they held on to their outperformances against the US banks, but Euro area stock prices nevertheless fell sharply after these stresses emerged in the US and Swiss banking markets, and yields, of course, on AT1 instruments soared as well. Now, while this will have raised banks' cost of equity, and of course their cost of funding more broadly, the middle chart shows that the contribution of those instruments to, well, I'm speaking here now of the AT1s, to overall banking sector funding is very small. I mean, it's no more than 1% of the total, and there's only about 30 banks in the Euro area that issue these instruments. Far more important are deposits, and with around half of them sourced from households, you can see that there on the chart as well. That makes Euro area bank funding structures resilient. It's also been a factor supporting bank profitability, with banks being able to pass higher interest rates through more rapidly on the asset than the liability sides of their balance sheets. Now, that said, looking ahead, and as shown on the right, funding liquidity is starting to pose challenges for banks. Now, we have a special feature which explains this indicator, but this funding liquidity index aims at measuring reliance on short-term funding and repo markets, and also the ability of banks to obtain funding from the central bank. And you can see notable in the decomposition here is the rise of redemption risk. So that's just basically means it's the risk of depositors withdrawing funds. And it's rising because of the failure to pass through higher interest rates to depositors, and that makes those depositors more likely to seek better returns elsewhere. We're certainly not saying that it increases run risk. It's just that it's a slower potential migration. But nevertheless, that of course puts competing pressures on the banks. And if we go to the next slide, competing pressures from other parts of the financial system on the banks, as those pressures mount, I think we can expect further pass through to deposits. So even though the net interest income of banks has been strengthened by these wide margins, I think ultimately they will have to narrow as banks compete with one another, or they have to compete with other non-bank competitors in a shrinking market. At the same time, banks could be faced with deteriorating asset quality. If you could look at the blue line on the far right, that's the share of total stage 2 loans in the overall loan portfolio. So these are the loans that are showing a significant increase in credit risk. Now, these have only gradually edged up since mid-2021, but the rise, as you can see there, it's more marked for household loans. And then similar to commercial property, those stage 2 ratios do correlate with economic growth expectations. So negative economic growth surprises could cause those ratios to go up further. So I'm going to go to the next slide, and that's my concluding slide, where we highlight 4 key sources of risk and vulnerabilities for Euro area financial stability. I'm going to go around this slide clockwise and maybe slowly. So, I mean, first, in the top right-hand corner, in view of high valuations and elevated interest rate volatility, we think financial markets remain vulnerable to disorderly adjustment. Second, economic uncertainties, and there are many. We think that they could unearth the liquidity and credit risk vulnerabilities of non-banks. Don't forget, I was showing the exposure of the non-bank sector to credit risk. It's important. Third, banks are starting to face funding liquidity risks, and we think if that coincides with it, it happens at the same time as the rise in credit risk, then some banks could face tests of their resilience going forward. And then fourth, we're starting to see the impact of higher interest rates on non-financial sectors. And the transmission, I think, here is still not complete. And because of that, I mean, in the environment that we're in, we are advocating in this issue of the Financial Stability Review that macroprudential policies should be targeted towards vulnerabilities, towards specific risks, with the objective of ensuring resilience through the challenges that lie ahead. So let me stop there.
So thank you, John. I'm really curious now to hear about Hanna's and Christina's reactions. Hanna, may I hand over to you?
Thank you so much, Jens, and thank you, Sveriges, for having me, for the invitation, and for the opportunity to comment on this super impressive package. It's already the presentation that we saw is breathtaking on all the aspects that you have touched upon in the package. I will note only sort of some of them, and focusing sort of putting on the glasses of a resolution and deposit insurance authority, and more or less sort of what we need to remember in our work. But first, if we skip to the following slide, I have just the key takeaways, and this is more or less what we already saw. My feeling of the main risks and vulnerabilities that you have listed in the report, where only a few have been listed here, is that the situation is rather fragile. So there are already signs of really deteriorating asset quality in the loan portfolios of different segments. And here, actually, I noted also that your small bit on the IFRS 9 loans, that I think it's super worrying that that we're a little bit blind in that they are not really fully capturing what we might see coming going forward. Then the real estate market, I find that is something that we really need to look into, and apparently it's not too far-fetched that something could turn really disorderly in that space. There are higher funding costs going forward for the euro area banks in the different bits, whether that deposits or also market funding. We also had a look at the what happened in the other markets, and there you mentioned the possibility of asset corrections or asset price corrections, particularly in the equity market, and that also sort of is a worrying sign. And then not to forget the situation of the sovereigns, where, well, high interest rates are impacting them as well, geopolitical tensions. But I would like to have mentioning the climate risk as well, which don't get too big a sort of room here. But that's also important to remember that in addition to all the risks that we already have, there might be something that we still don't understand from the climate risk and the green transition. Then as to the key policy messages, it's really easy to subscribe to these, that the macroprudential policies should stay as is and sort of or maintained. I will come back to our comments on the banking union and finalizing that and EDIS, and then I do also understand the need for some measures on the with respect to structural vulnerabilities in the non-bank side. Then if we go to the following slide, so here is go to the following slide, please. Thank you. So these are very overall reactions as putting my resolution deposit insurance authority hat on. First, coming back to, this is a really impressive work that you and the you at ECB and also the euro area central banks are doing to identify all the risks that are out there, what we need to worry about, and making us and all the other stakeholders aware of these, and then also pushing for mitigating measures. That said, even though we try to avoid all the risks and all the crises, we acknowledge that there still might be bank failures also on our backyard. So we, as resolution and deposit insurance authorities, really need to be ready to deal with these situations and make sure that they are not snowballing into anything large scale at all. And what I really learned, or sort of what reminded of from the FSR, is that these crises can come from any direction, and we need to be ready for almost anything. And this is also something that we need to learn from the FSR and go through the different risks and see whether do we have the right tools, or what kind of tools would we use as a resolution authority, for example, to make sure that we handle a situation in case that they happen. And here I just jotted it to like very high level, that I think during this spring we have, if not earlier, then we have learned that that it's liquidity crisis that will really be the key. And this is something that we need to be prepared for, and the situation is escalating really fast, and at the same time a fast escalating crisis where the situation is really wobbly in the market and in deposits sphere and elsewhere. This is the place where we need to do some tough decisions as well. But on the same note, we can't forget that, like, the traditional crisis, which is more related to capital position and losses from loans, for example. They are not there yet, but we can't forget that either. And then the final sort of first impression is that the report is really full of good insights and good information. But still, as we are focusing on the really tail of things, the banks that will possibly fail, we are really in the tail. So we then need to, in addition to this information, we need to have a very close dialogue with banks and supervisors to understand what's really goes on in the different banks. And then if we can go to the next slide. So what I did was to not comment all the report, but I sort of found one of the special features particularly interesting. Not fell in love with it, but I think it was really a good one on the market and funding liquidity. And this is sort of a checklist for us to remember what we need to do going forward. The first one is to really all of us need to read that special feature and remember to understand the different dimensions of liquidity and their interrelations when we have a look at for example, the bank's funding plans and see how well they are doing in meeting the MREL targets that are due fairly soon. We also need to, when we are discussing or presenting or talking about MREL targets and why they are important, I think we also need to sort of market them as a good way of making the funding mix a bit stable, noting that the deposits might not be as sticky as we have assumed going or previously. Then there is a very interesting sort of assessment or discussion on market makers and banks' role in market making. And this is something that we really need to dig into when we do the public interest assessment. We are also looking into whether trading functions are critical. So we will make use of your assessment here. Then a point on whether or not assets are encumbered. We have seen this trend going on for a long time, but this is something we also need to remember, and this has quite big implications on what we would do in case there would be a resolution case as well, whether there is still some collateral that could be mobilized for liquidity. And the following point is also related to liquidity. I think it's based on what we read in the report, but also on other things. We need to really be ready to make decisions in very challenging liquidity situations. At time a bank might be failing. And for that, I think it's very important that we have pre-planned arrangements so that we don't need to make them up as they come. In addition to the SUERF backstop, which not yet is fully ratified, but in addition to that, I think it would be good also to have other mechanisms for liquidity and resolution to make that really work if needed ever. And then final more going concern issue is that the decline in deposit growth rate naturally goes into also how much we are collecting for contributions to the resolution and deposit insurance funds, which in the end also have implications for the profitability of banks as they need to pay these contributions to us. As I mentioned, we have resolution and deposit insurance under the same roof. And this has been from the start a very sort of beneficial way of having it. So would welcome that elsewhere as well. We have the ability to look at the different tools as a continuum and handle any crisis in a consistent manner as we have the tools ourselves. This also sort of ensures a seamless cooperation across the deposit and insurance and resolution authority, as some of the assessment that we need to do are fairly similar. So then it's very, very good to do them together. And then, well, needless to say, when it comes to cooperating between authorities, it's efficient use of data as we are under the same roof. We are also very much in favor of finalizing the banking union with a common European deposit insurance scheme. That would ensure that the depositors in every member state have the same position. It's not linked to the situation of the sovereign, which also then breaks the nexus of sovereign bank nexus as well, rather than tightening it. And we also see that it would be better use of the funds. We actually have an additional thing on the wish list is to combine EDs with the SRF and also on the fund side have them these under the same roof, as that would further improve the credibility of the fund, and then also remove any overlaps and conflict of interest in between sort of who owns the funds and who decides upon the use and such. So that's our wish for the institutional setup. And I close here. Thank you.
Thank you so much, Hanna. Also for adding a resolution and deposit insurance perspective, and also for your suggestions for institutional improvements. We now turn to Cristina.
So hi everyone. Again, thank you. It's actually not easy to present after John and after Hanna, and I actually expected Hanna to cover the deposit and resolution side of the story. So I've tried to come up with some not so much out of the box, because we probably heard about it before, but some things that could lead to new boxes for the next FSR, something that might help the development of, more analysis, because the FSR of the ECB, as everyone knows, is very rich with analysis and special features. And I also suggest everyone to read the climate and sovereign risk boxes, which is a very interesting one, as a special feature. So I thought I will focus on the March turmoil of 2023. The FSR covers it in several different places, but I thought that it would be interesting to look at what I have not seen in the FSR and the aspects that we can actually work further on. So I will not, in this first slide that actually Dragan is showing for you, I made a very simple summary of what has happened in March 23. Two banks in completely different jurisdiction, all of a sudden, were in trouble. And everything actually we know started in the United States. And there were many, many reasons why the Silicon Valley Bank failed. What was very interesting to me, though, was that the contagion to Credit Suisse and what happened to Credit Suisse afterwards. So I thought that starting from this thought, we could collect a couple of ideas about where to look for risks that in an uncertain environment could be amplified into threats for financial stability eventually. So if you go to the next slide, please, Diana. So I divided in the interest of time, so I actually divided my presentation in two parts. I will focus on two main comments. One is the effect of social media on financial markets. And another one is actually whether we should do better into measuring interconnectedness, what a difficult word for an Italian, and spillover effects. And then I have additional points on mega mergers and hidden interest rates risk. I might not have to go there if we don't have time, but some slides will be also on that. So if you can go to the next slide, let me start with social media effects on financial markets, right? I actually know nothing about this topic, even though I've been studying finance for many years. This is not my topic. And therefore, in order to make this discussion, yesterday I thought I will have a look at Google Scholar. It might actually provide some insights, some few papers that I can look at in order to come up with, some good comments for John. And it turned out that only if you look at year 2023, there are 70,000 search results that you get on Google Scholar by Googling social media effects on financial markets. And I'm very hard working person, but it would be too much to read overnight, right? And even if you try to narrow it down to the top 5 finance journals, there are many contributions. So I did what the Generation Z usually does, and I turned to artificial intelligence. And I actually asked ChatGPT whether it could summarize the results for me. And then I took all of the results and I actually looked through it, and given my experience in the finance world, I thought I will try to kind of classify in positive results, negative results, and unclear results, right? So basically, the results that I summarize here are divided in this way. Social media could have positive effects on financial markets because they could improve market efficiency through reducing information asymmetries, all right? And that I think all of us can agree on. The more information, the better. But on the other hand, there is research, or there is ChatGPT has found research that shows that there's been an increase in market volatility. It could lead to exaggerated market movements and bubbles, and especially often events of false information, rumors, and pump and dump schemes could actually have created big distortions. And we all remember some events related to crypto securities, right? Then there are also non-clear results. For example, trading strategies. Apparently, artificial intelligence could be used to collect information from social media in order to create trading strategies for mutual funds. Or there are also actually results about how increased media attention could lead to higher trading volume in specific stocks, right? When you put the highlight on specific banks or specific stock, all of a sudden you see increasing trading volume and sudden price movements, positive or negative, depending on the news, but usually negative news have larger effects. And these are usually short-term lived effects, even though the effect on long-term is not really clear. Now, as I said, all of these results are summarized using ChatGPT, and then I use my own expertise to try to read through it. But at the end of the day, this also shows that there is a lot of information out there. But this information has to be read and has to be actually synthesized from someone that actually can understand the information. And I'm still suggesting that we read all of the papers, maybe making a smaller selection. So start from the starting point. If you move to the next slide, I was thinking that this basically is telling us that this is still a new and growing field of financial research. And most of the papers that I've actually seen don't really look at the connection with financial stability. But nevertheless, actually, we've seen the effects of social media and spreading of information has had on making faster deposit runs. So that's changed the nature of deposit run. So it might be interesting to look into the specific. This also means that we cannot limit in any way people's freedom, but may want to control the flow of information, making information concise, transparent, and verifiable, which is, I think, very important because the overflow of information is also counterproductive. And also maybe we should prepare to quickly step in order to break some vicious circle when negative information starts spiraling out. And I also wanted to go back to ChatGPT. the use of artificial intelligence means that financial literacy becomes very important. And that could be also seen as a way to make system more resilient, improving actually financial literacy, which is something that is becoming more important, I think, in the current uncertain world. So if you go to the next slide, my next comment will be about interconnectedness. How are we measuring this? And I'm actually going to use a paper that is a working paper from the ECB, which was published as a working paper in March 2023. We have seen risk spreading in different jurisdictions between non-bank financial institutions and bank financial institutions, and most of this spreading we see through stock markets and ownership of holdings of certain types of securities. But there is more and more research that shows that actually banks and funds often belong to the same holding companies. So they have ownership links beyond the investment of banks into mutual funds or the investment of mutual funds into banks per se. And this type of ownership links could actually amplify an episode of distress. So basically what I'm showing you in these three pictures here, if you focus on the picture, figure number 2, which is at the extreme left, you see basically the blue line, and these are straight from the paper from Bagattini and others 2023. You see basically the blue line is the share of EU funds that are affiliated to a bank. And you can see that from 2024, from 2014 to 2020, the share has been going down, but it's still around 20%. Actually, I was looking that Bank Santander is affiliated with 1,200 and 500 to 1,200 funds and more. So the numbers are quite substantial. Then in the figure at the center, you see that the actually ultimate parents of these funds are not even usually in Europe. If you look at the largest red bar, is also where you are one of the largest blue bars, and the blue bars is the amount of affiliated for the total net asset of affiliated funds with a parent in the United States. And we have seen already how easy is the transmission between the US to the European banks. So this could be an additional way in which risk could actually be transmitted, especially because this particular paper is about the fact that banks that belong to the same holding company than funds can support the funds when the funds have outflows. But if the banks itself are having distress, then they cannot support the funds. And this is what you see in the Credit Suisse actually event. In the last part on the right side, you see, and this is a newspaper article, and this is the outflow from the Credit Suisse ETF funds and open funds. And you can see that at the time of the event that implicated Credit Suisse, the funds themselves were having extremely high outflows. And we also know that the actual stock price of Credit Suisse was falling down. So it was not only the bank itself which was suffering, but also the affiliated funds. If you could please move to the next slide. So this basically gave me idea. Next slide. I hope you hear me. Yes, please. So basically what this implies to me is that maybe we need more analysis about ownership connections, especially when it comes to real estate funds. Because in the FSI, you state clearly that real estate funds have been having troubles somehow, are very vulnerable and so on. So could the risk spread from actually the funds themselves to the bank in the same holding companies? We don't really know anything about this, but we could not exclude that it is true that the risk can spread from banks to the mutual funds affiliated. It could also go the other way around. And I think this would be a very interesting box or special future maybe to look at. And the other thing which I think is very important is what I was talking about, the parent companies. Most of the parent companies are actually in different jurisdictions, and therefore this calls for harmonization in the implementation of existing rules to make sure that basically there is a play level field for all of the banks, despite the size and everything else. So if you could please go to the next slide. So now I have some additional comments on two main points. One is the mega mergers. And I think this is actually low-hanging fruit. And John, you probably have heard this before. But we always talk about consolidation in the banking industry like a positive thing, especially in some specific countries where the banking system is very fragmented, right? But maybe it's time to think about what are the costs of these mergers and under which conditions they are really actually beneficial. Because if we think about the UBS Credit Suisse mergers that have made an already very concentrated banking system even more concentrated. And And I think this is worth some further analysis, not about this specific case, but about other potential cases. And then, of course, the issue of hidden interest rate risk, which apparently might not be a concern, according to the FSR, is not so much maybe a concern. Banks have done quite well during this, at least the large one, have done quite well during this stress period. But hidden interest risk could be still a risk for them, or it could be a risk for banks that are not the largest one. And of course, regulation is very important. We need resilient banks, capital requirements, and so on and so on. But these are not substitute for risk management, asset liquidity, and also sound business strategies and corporate governance, if I might add. And also, especially when Silicon Valley Bank happened, everyone was very surprised, or at least I was very surprised, that they didn't even think about hedging interest rate risk. But what if they had hedged interest rate risk? Who would have been on the other side of the trade? So hedging doesn't mean that it disappears. We are just moving it somewhere else. And what happens if we move this risk to unregulated entities, or who is holding this risk? Eventually, we should also ask ourselves these questions. If you please go to the next slide. The next slide is basically my final one. And I was actually, this is more of an observation, right? So in the FSR, it's very clear that there's substantial evidence that non-bank financial institutions are decreasing, even though this decrease, as you say, is not very large, but they are decreasing their exposure to high-yield securities. But then who is buying these high-yield securities? Because in the box number 6, chart AB, you look, so basically this one on the left side, and if you look at this last 4 bars, you see the yellow part is actually the outstanding amount of high yield bonds. And this is increased between 2021 and 2022, and even the new issuances have increased. So the amount outstanding is still quite substantial. There have been new issuances, and even though some funds are reducing their exposure, then the question is who is buying these securities? So who is bearing the risk? Since we are saying that small episode of stress could actually amplify quite quickly in an uncertain environment, then it would be interesting also to look at these features. So, and then let me conclude. I may have gone too fast, but I hope it was clear. So basically, the FSR is difficult to comment, but it's a very interesting read, and I really suggest for everyone to have a look at it for inspiration as well. Thank you.
Thank you very much, Cristina. I'm aware that time is almost over. I still want to add to John's, food for thought, 2 comments from the chat. 2 questions in the chat are very interesting. One is from John Mulbauer, a renowned expert in real estate markets and financial stability. And John is asking, is there a parallel between banks' losses on government bond portfolios and implied losses on their portfolio of fixed rate mortgages? Or does the higher profitability from the increased spread between lending and deposit rates and sticky deposits compensate? The second question from Fergal McCann is specifically what dimensions of a more complete banking union would be the most effective in the face of current threats? And would elements of a more complete banking union have helped much in the face of the kind of stress experienced in March in the US?
Thanks a lot, Ernest. And let me also thank Hanna and Cristina for those incredibly rich discussions. Thank you. Clearly both of you read the FSR very carefully, and there's so much in what you said that I really can't respond to all of it. But I thought I'd do something cheeky. I think Fergal is asking a question about specifically what dimensions of a more complete banking union would be most effective. Well, I think there's a number of dimensions to that, but I think our position on EDIS has been clear for quite some time. There are 3 pillars of the banking union: supervision, resolution, and deposit insurance. EDIS. I think maybe one way of seeing the importance of deposit insurance is, to ask yourself the question, how would the US banking system have managed, how would they have managed to resolve and deal with the bank failures that they had without the FDIC? Because I think that's essentially the question that we're asking there, and I think we got to see it in action and how it works and how effectively it works. So I think this is what Hanna was saying. So, I mean, I think that would be, of course, you're asking in the face of what we faced in the question of whether it's the risk that we face in the euro area, we never got anywhere near what we saw in the US, of course. So we're talking about a counterfactual situation. John Mudbar's question is very interesting, and there are two dimensions to it as well. I mean, I think it's good. I mean, making that parallel is useful. I think, because I mean, it kind of raises awareness, or maybe it's useful for the thinking about this whole issue of held to maturity and held to maturity portfolio, the mark-to-market portfolios. I mean, in a way, those fixed rate mortgages, I mean, they're generally not marketable, so they will be held at book value, and you will see them changing over time at amortized cost. But I mean, I think the point is, and this whole issue around held to maturity is really, it only really matters if you're distinguishing between a going and a gone concern. I mean, those losses, the unrealized losses, are not actually losses unless they have to be realized. It's a kind of a tautology what I've just said, but it's really true. You're not going to endure those losses unless you are in such a bad situation that you have to start selling those assets. So I think a good way of thinking about it, and maybe the way that you're raising the question, John, is a good way of thinking about it. If you're talking about a going concern that is never going to need to sell those assets, then you're really talking about opportunity cost. Okay, they're locked into a low yielding asset or a low yielding mortgage that they're never going to have to sell, but they will just earn lower income on that than they otherwise would have if they'd had those funds available to deploy to another activity. And so I think and then asking the question, is it compensated for by the higher profitability? But I mean, in a way, those loan contracts should be priced for that risk, and I mean, they often will be, unless we get a complete breakdown of lending standards, which I don't think that we really ever thought that we saw happening in the euro area. I think I'd like to. I mean, I really enjoyed Cristina's discussion, because of the suggestions for future work. I mean, that's great. And I mean, this is one of the things that I was saying about this forum. It's really helpful, and like you, I mean, I'm fantastic that you mentioned ChatGPT. I never thought of using ChatGPT to do a literature survey. That's great.
There you go. I thought about it yesterday. Yeah.
Very good. I mean, I can tell you, I can confess that I'm a big ChatGPT fan as well, and I use it for all kinds of things. But yeah. I mean, I think on the social media, I think when we saw the first signs that it was becoming important, I mean, you remember this whole thing about meme stocks, GameStop, and all of that, Wall Street bets, and I mean, people getting into buying totally overvalued stocks and silly stuff, and we thought, well, we didn't think that this would be a source of a systemic crisis, but you're right. Now we have seen an aspect to it that is actually very, very dangerous. Because and it comes back to, and I think I'd like to thank Hanna for underscoring the point that we again understood the link between liquidity risk and solvency risk. The liquidity risk, if it materializes, can cause an insolvency problem, and that, of course, is what happens when we get bank runs. Because then when banks are forced to sell assets. I just looked at a paper, and I think this backs up what you're saying, Cristina. The Fed has just come out with a paper just in the last few days, I think it was last week, where they look at, it's called Understanding the Speed and Size of Bank Runs in a Historical Comparison. And they look at a couple of factors, like what percentage of the deposits were covered with deposit insurance, what the outflows were, and how quick it took for those outflows. So just for example, Washington Mutual, which is still up there as the #1 bank failure in the US. I mean, that was back in September 2008. They had 10% deposit outflow in 16 days, which was 12 business days. Then you look at Signature Bank and Silicon Bank, they're both basically the same. I mean, they're losing 60% in one case, more than around 30% of deposits in one day. And they were closed because that was expected to continue the following day. First Republic, 57% of deposits gone in 5 to 10 business days. You know, so I mean, we've got a doubling, tripling. We have a tenfold speed if we compare, you know, Silicon Valley with Washington Mutual. So I mean, this really is, and that, yeah, I mean, that means, I mean, that forces, of course, management authorities to respond much more quickly than was the case in the past. It has got important policy implications, also about assumptions that are made about, you know, customer outflow, deposit outflows for some of the important liquidity ratios and so on. So I think this is, I mean, touching upon some of the main lessons of what we saw. I mean, I think these, I mean, both of you, I think together, Hanna and Cristina, you identified those points. And so thank you very much. And I mean, colleagues have listened carefully, Cristina, to your presentation. I think they will take up your suggestions. We welcome that very much.
Thank you, John. Hanna, do you want to make any final comments?
I have to comment on this banking union question. For me, the US banks, they were fairly large, and in a European setting or a banking union setting, they would have been designated as significant institutions, and I would be fairly surprised if they wouldn't have had a resolution strategy. So not a bankruptcy or sort of the going into to pay out by a deposit guarantee fund. But it is still very important to make sure that also sort of the smaller banks or the payouts for them are made efficient, and that the funds on that still are sort of, as we are now, the national funds could be emptied fairly soon with bankruptcy cases. So that at least, then I'm super intrigued also of this deposit run and the interconnectedness, and how we can sort of better understand what could actually trigger it. And I also, in one of the points that I couldn't make, it was sort of also back to the green transition, whether rumors or sort of the flavors or sentiment related to, okay, this bank is not maybe engaging fully in green transition, and then you have the social media run or sort of rumors that this is not a good bank, and then you have an outflow even based on that. But how do we as authority understand how sticky deposits are and or not? That would be super cool to look into further. So thank you.
Thank you, Hanna. Now, Cristina, before I hand over to you, I want to draw your attention to a final question which we received from Michael Losch. Namely, how do you see the role of classic merger control in that context? Was there an assessment? How can competition concerns be better taken into account in future cases? I think this relates directly to one of the points that you made in your PowerPoint.
Yes, it does. But I actually don't know whether an assessment was made, because as you can imagine, I wasn't involved. But I think that it would have actually, in that case, it was also a very hasty decision, right? They didn't really have any time. They had to find a solution. That's my explanation for creating a bank that could be too big to fail as well, right? It's created a bank that has not only basically market dominance, as in the comment I see before, but also might be too big to fail if things go bad. So I think we should be more aware, and exactly as we were saying before, if we make banks more resilient and if we can make information more transparent, we might not need to do it again, right? So that would be, or maybe if banks have better resolution living wills, or we have the tools fully developed, because then there's been an issue with resolution. Also, it was not the resolution authority that did all of this, was involved in this. So there's been a few issues with this, but I would not know whether it could have been done differently at that time. But I think we should have done differently if possible. It would have been done differently, most likely, if possible. But the conditions weren't there.
Thank you very much, Cristina. This concludes today's SUERF Buffy Bocconi e-lecture on key takeaways from the ECB's FSR. A great thank you to John, Hanna, and Cristina for your excellent presentations. and to John, Fergal, and Michael for your questions, and to all of you for your interest and for your participation. Thank you, bye-bye, and take care.
Bye. Thank you. Bye-bye.
Bye-bye.
Bye.
Bye-bye.